Hi everyone, in this video let's discuss about amalgamation of companies. So this is one of the most awaited topic in CA Inter, like this is the most frequently asked question in every exam, right? So let's discuss about it. So before moving on to theory areas to sort the sums, everything, so we'll first understand why there is a need for amalgamation and then what is amalgamation, right? Okay. In this modern era where there is an increase in competition, there is a very much need and there is a very much fact that only the sure business will survive and all the loss making business or all the less innovative business will be closing down or cutting down its operation and they will not be able to survive the cutthroat competition, right? Only those which are very shrewd, very innovative, those business will survive the cutthroat competition and make huge profits. So now, what is relevant with amalgamation? Yeah, that's when the shrewd business will negotiate with the closing, that is less innovative businesses and take over their operations. Okay, this process will be known as a kind of amalgamation. This is an example. So let's assume there is a company A, okay, which is making huge profits, okay, in one line of business. In the same line of business, there is a company B, which is, even though it has a huge capital investment, huge, very good capital equipment, still it is making losses. Okay. Now the company A, what it will do, instead of buying only the equipment, it will buy the entire set of factory, everything from the company B. That and this will be known as amalgamation. Okay. So let's read it here. Amalgamation means an amalgamation pursuant to the provisions of the Companies Act 2013 or any other statute which may be applicable to the companies and includes a merger. So here, this amalgamation in general business parlance will be known as corporate marriages. Okay, corporate marriages, or it could be like strategic alliances, business partnering. These are the other terms that are used in general business to refer to amalgamation. So amalgamation here refers to the process of merger of two or more companies into a single entity, or when one company takes over the other by outright purchase. So let's understand both, okay, using an example. The first thing was process of merger of two or more companies into a single entity. Right. So for this we have an example. Let's have company A and company B are there, okay, and they decide based on negotiation or based on an agreement within them to amalgamate themselves to form a new company C. So now, company A and company B will be known as transfer our company. Company A and company B will be known as transfer our company, and the new company C will be known as transferee company. Transferee company. So now let's have another example for where one company takes over the other one by outright purchase. Here, let's assume company A is taken over by company B. Company A is taken over by company B, which means company B is purchasing company A. Right? Now, company A will be known as transferor company, and company B will be known as what? Transferee company. So, this case will be an example for absorption. It's absorbing, right? Fully taking over. That is known as absorption. Now, let's have another example. Example number 3. Now, company A is a company which is operating but is suffering huge losses for the past 5 years. Okay. Now, company B is a new company which is being floated, and the only objective is to take over this existing company A. Okay. Here, company A will still be known as transferor company, and company B will be known as transferee company. But this process will be known as external reconstruction. External reconstruction. Okay. So now, let's move on. What are the topics given here? The accounting for amalgamation depends on whether the amalgamation is in the nature of merger or in the nature of purchase. Nature of merger or in the nature of purchase. In amalgamation, generally we have two companies known as vendor company or transferor company, vendee company or transferee company. What is this? We had an example. A and B were there. Now they form into a new company C. Now A and B will be known as transferor company. C, the new company, will be known as transferee company. The result will be known as will be known as transferee. Okay, in this case, right? Now, the term amalgamation contemplates two kinds of activities. Two or more companies join to form a new company, or absorption and blending of one by the other. What happened in B purchased A, right? where B is going to blend with A. Okay, now the concept given above can be understood from the following table of differences. This is the key differences. Okay, though we have many other differences, this is the key differences. Okay, meaning for amalgamation, two or more companies are owned up and a new company is formed to take over the business. In absorption, in this case, an existing company takes over the business of one or more existing companies. External reconstruction, in this case, a newly formed company takes over the business of an existing company. We have three different examples to understand these three different topics. Now, number of resultant in new companies. Only one resultant company is formed. Two companies are wound up to form a single resultant company. No new resultant company is formed. Only one resultant company is formed. In this case, a newly formed company takes over the business of an existing company. What is an objective? Amalgamation is done to cut competition and to reap the benefits of economies of scale. Economies of scale. Now, both the companies' customers will be the customers of one single entity. Now, absorption is done to cut the competition and reap the economies of large-scale production. Now, external reconstruction is done to reorganize the financial structure of the company. Reorganization of financial structure of the company is what the objective of the external reconstruction. Now, let's understand the key term purchase consideration. First, let's go over what is the definition and then we will understand it. Okay. AS14 defines the term purchase consideration as the aggregate of the shares and other securities issued and the payment made in the form of cash or other assets to the shareholders of the transferor company, which means it is nothing but the aggregate of the shares and other securities which are being issued and any other cash or other assets by the transferee company to the shareholders of the transferor company. Who has to pay? Buyer has to pay to the seller, right? So transferee is paying to the transferor. Okay. In simple words, the price payable by the transferee company, that is buying company, to the transferor company, selling company, for taking over the business of the selling company. Okay, clear? Nothing but cash, securities, shares, or any other assets given as a consideration for the purchase of the business of the transferor company. Now, it is important to know the amount paid towards the equity shareholders and preference shareholders is only considered as a purchase consideration under AS14. Only the amount paid to equity and preference shareholders, that is merely the shareholders, is considered as purchase consideration and not towards debt. Now, hence, it should be noted that the purchase consideration does not include the sum which the transferee company will pay directly to the debenture holders or creditors of the company. If a certain liability of transfer company has not been taken over by the transferee company, it will be discharged by the transferor company. If I am not taking over some liability, that liability will be discharged by the transferor company. Now, the purchase consideration can be computed in the following methods. There are certain methods. Okay, we have four methods. One is lump sum method. The transferee company agrees to pay a lump sum fixed amount to the shareholders of the transferor company. I'm going to pay some lump sum amount. You have to do every amount. So that is known as lump sum method. Net payment method makes individual payments to equity shareholders and preference shareholders either by way of cash, issue securities, or depends. So it makes individual payments. And asset methods. The purchase consideration is arrived based on the value of the assets less value of say liabilities, excluding the capital and reserves taken over by the transferee company. So what I'm going to take over all the assets and liabilities. So net value will be known as the purchase consideration. As per AS14, the value of assets and liabilities shall be the value as agreed between two parties. It should be the value which is agreed between the two parties. If there is no value agreed, then it will be taken at book value. If I'm going to agree with some value, then I will take that. If I'm not agreeing at some value, then what I'll do, I will take just the book value, which is complete as per the existing accounting standards. Now, intrinsic value method. Under this method, the purchase consideration is calculated the intrinsic value of the shares of the transferor company or the transferee company, either the intrinsic value of the transferor company or intrinsic value of the transferee company. The ratio of shares to B shares computed and multiplied with the intrinsic value. So I have to compute and then multiply it with the intrinsic value to arrive at the purchase consideration. Okay, these are the four methods. What are the methods? Let's repeat. Lump sum method, net payment method, net assets method, and intrinsic value method. Any of the method or a combination of the above methods can be used to calculate the purchase consideration. So, we discussed it for accounting purpose. There are two types of amalgamation. One is amalgamation in the nature of merger and amalgamation in the nature of purchase. Right. There are two main methods for accounting for amalgamation. The nature of merger will be known as pooling of interest method and purchase will be known as purchase method. Okay. So for nature of merger, pooling of interest method will be applied, and for purchase method will be applied. Okay. Let's read it out. The first method is used in the case of amalgamation in the nature of merger, wherein the conditions as per AS14 are fulfilled, and the second method is used in the case of amalgamation in the nature of purchase. Let's understand like this. Whenever the conditions laid down as per AS14 for the purpose of amalgamation as per the nature of merger is not fulfilled, that will be taken as an amalgamation in the nature of purchase. Okay, what are the conditions? It is very important. This is very important. Is an amalgamation which satisfies all the following conditions. So all five conditions have to be cumulatively satisfied. Okay. Amalgamation in the nature of merger is an amalgamation which satisfies all the following conditions. Okay. All the assets and liabilities of the transferor companies becomes after amalgamation becomes the assets and liabilities of the transferee company. All the assets and liabilities, nothing, one cannot be left. Every asset and every liability of the transferor company should become the assets and liability of the transferee companies. என்னன்னா இப்போ செல்லிங் கம்பெனி இந்த ஏ லிமிடெட் பி லிமிடெட் எடுத்தோம்னா இப்போ ஏ லிமிடெட் பி லிமிடெட் இருக்குன்னு வச்சுக்கலாம். ஓகேவா? அப்போ ஏ லிமிடெட் எல்லா சொத்து எல்லா லயபிலிட்டி எல்லாத்தையுமே வந்து பி லிமிடெட் ஃபுல்லா எடுத்துக்கணும். ஓகேவா? தட்ஸ் வென் and that should become the assets and liability of the transferee company. Shareholders holding not less than 90% of the face value of the equity shares, not some other price. It is face value. Okay, no fair value. There's some not any other price. Not less than 90% of the face value of the equity shares of the transferor company, other than the equity shares already held therein immediately before amalgamation by the transferee company or its subsidiaries or their nominees, becomes the equity shareholders of the transferee company by virtue of the amalgamation. So what consideration I'm going to give? First is shares. Okay, so the shareholders of the transferor company, to the extent of not less than 90% of the face value of the equity shares, should become the shareholders of the transferee company. Now, the consideration for amalgamation receivable by those equity shareholders of the transferor company who agree to become the equity shareholders of the transferee company is discharged by the transferee company wholly by issue of equity shares. Only equity shares can be issued in the transferee company, except that cash will be paid in respect of fractional shares. If there is 4.51 shares, so for 4 shares I have to give. For 0.51, I could discharge by way of cash. Okay, I could not do 3, I will give 1.51, I will discharge in cash. That's all not possible. Okay, the business of the transferor company is intended to be carried on after amalgamation with the transferee company. Intended to be carried on. I have to carry on the business of the transferor company by the transferee company. No adjustment is intended to be made to the book value of the assets and liabilities of the transferor company when they are incorporated in the financial statements of the transferee company, except for to ensure the uniformity of accounting policies. Except for ensuring the uniformity of accounting policy, I should not make any other adjustment to the value of the assets and liabilities when it is recorded initially. For the first time when I'm going to record it in the books of accounts, I should not make any changes to the value. Just record it in the book value which I'm going to get it transferred. Okay. Even if one of the conditions are not satisfied or one or more conditions is not satisfied, then it will be the called as amalgamation in the nature of purchase. So let's repeat all the conditions. All the assets and liabilities of the transferor company becomes the after amalgamation, the assets and liabilities of the transferee company. Shareholders holding not less than 90% of the face value of the equity shares of the transferor company becomes the equity shareholders of the transferee company by virtue of the amalgamation. The consideration for the amalgamation receivable by those equity shareholders of the transferor company who agree to become the equity shareholders of the transferee company is discharged by the transferee company wholly by the issue of equity shares in the transferee company, except that the cash may be paid in respect of the fractional shares. A business of transfer our company is intended to be carried on after the amalgamation by the transferee company. No adjustment is intended to be made to the book value of the assets and liabilities of the transfer our company when they are incorporated in the financial statements of the transferee company, except to ensure the uniformity of accounting policies. So all the assets and liabilities should be there. 90 percentage of the face value of the equity shareholders should become the shareholders of the new company. And then what is that? Consideration should be receivable only by way of equity shares. For fractional share, could be received in way of cash. Business should be continued, and no adjustment should be made to the book value of the assets and liabilities. Clear? Let's repeat. All the assets and liabilities should become the assets and liability of the transferee company. So consideration should be given only by way of equity shares. For fractional, it could be in way of cash. Shareholders holding not less than 90% should become the shareholders of the new company, and then the business should be carried on, and no adjustment should be made to the book value of the assets and liabilities, except to ensure the uniformity of the accounting policies. If any of the conditions is not satisfied, then it will be known as amalgamation in the nature of purchase. Amalgamation in the nature of purchase. Okay, let's move on. Okay, pooling of interest method. Okay, what happens in this method? In case of pooling of interest method, the amount to be adjusted against reserve can be computed in the following three steps. We have three-step model here. Okay, first step. Step 1. What is step 1? Equity share capital plus preference share capital issued plus any other consideration considered in the form of cash and other assets by the transferee uh, company. Okay, equity share capital plus preference share capital issued plus any other additional consideration in the form of cash and other assets by the transferee company. Step 2. Existing equity share capital plus existing preference share capital in the books of the transferor company. Step 3. The amount to be adjusted from the reserves of the transferee company. These are the three steps. Okay. First, I have to compute what? Add equity share capital plus preference share capital issued plus any other consideration in the form of cash or other assets by the transfer, which is given by the transferee company. After reduce what is the amount already there in the transfer company books for equity share capital and existing preference share capital, then that amount will be shown as reserves, which is to be adjusted against reserves. Okay, clear? So whatever the adjustment is there, that will be there only in reserves account. Okay. So as a result, essentially what happens? Difference between the amount recorded as a share capital issued and the amount already there in the transfer company share capital should be adjusted in the reserves of the financial statements of the transferee company. Okay. So under pooling of interest method, all assets, all liabilities, all reserves of the transfer company will be taken over by the transferee company. Okay. Here what happens is that, let me write it here. Okay. All assets, all liabilities, including reserves, will be taken over. Okay, well, that's why we are adjusting the difference in reserves. Okay, understood? Now, let's move on. Purchase method. Assets and liabilities of the transferor company should be incorporated their existing carrying amounts, or the purchase consideration should be allocated to the individual identifiable assets and liabilities on the basis of their fair values at the rate of amalgamation. So we have two methods here. Okay, it's our option. Okay, first one is that I can just incorporate the existing carrying amount, or I can allocate the purchase consideration on the basis of individual fair values, identifiable assets fair value at the rate of amalgamation. In the case of purchase method, the amount to be transferred to capital reserve or to be recorded as goodwill can be computed as follows. Because there is a purchase of a business, there is a need for what? Goodwill, right? There is some goodwill or capital reserve. So I have to compute that one. So what I have to do? I have to find out the net assets using the following formula. Total assets minus outside liabilities. Total assets minus outside liability will be giving me net asset. Compute the purchase consideration using any of the method. We have four methods. Like what are those? Lump sum, Net payment, net assets, and try to remember. Intrinsic value. Good. Now, if step 1 minus step 2 is a positive amount, then it is a capital reserve. So net assets minus purchase consideration, I'm going to have paid less. That's why it is a capital reserve. Okay. Since asset proceed more than the amount paid for consideration to acquire them, then or else I've paid more, then it is a goodwill. I paid for the goodwill, that is an intangible asset. That's why I'm going to record it. Okay, since the amount paid for acquiring this is more than net asset, which is technically due to its goodwill, good name, that's brand or something like that. Okay, now. No. Treatment of reserves and the purchase. No reserves and statutory reserves of the transferor company should be incorporated in the financial statements of the transferee company. I should not bring in any reserves to transferor company to the books of transferee company except for statutory reserves. For example, there could be some reserves on as capital redemption reserve or something which is mandated by the statutory requirements. CSR reserve could be there. Okay, that alone should be brought in into the transferee's book. The balance of the profit and loss of general reserves of the transferor company are not recorded at all. Not recorded at all. Not recorded at all. Though normally in an amalgamation nature of purchase, the identity of reserves is not preserved, as an exception is made only in respect of statutory reserves. Such reserves shall retain their identity in the financial statement of the transferee company in the same form in which they appeared in the financial statement of the transferor company till the time the identity is required to be maintained to comply with the relevant statute. Amalgamation adjustment reserve is debited to bring in the statutory reserves of the transferor company. This is represented as a deduction from the reserves of the transferee company after amalgamation. This exception is made only in those amalgamations where the requirements of the relevant statute for recording the statutory reserves in the books of the transferee company are complied with. Statutory reserves of the transferor company should be incorporated in the balance sheet of the transferee company by way of the following journal entry: amalgamation adjustment reserves account to statutory reserve account. Once after time period, to show the statutory reserves is over, both the reserves and aforesaid amount is reversed. Amalgamation adjustment reserve has to be shown as a separate line item, which implies that this is a debit. This debit cannot be set off against statutory reserve taken over, and therefore this presentation will be as follows. How it will be presented: statutory reserve taken over from the transfer company, general reserve, retained earnings, amalgamation adjustment reserve, amalgamation adjustment reserve. So let's repeat: statutory reserve, general reserve, retained earnings, and amalgamation adjustment reserve, which will be showing a set of balance. Okay, where it will be presented: amalgamation adjustment reserve is presented in the financial statement of the transferee company as other current asset, a separate line item with a negative sign under the reserve surplus, or the under other non-current asset, which is correct one, separate line item with a negative sign, separate line item with a negative sign under reserves and surplus. Okay, great. Okay, now journal entries to close the books of the vendor company. So this we will continue in the next video. Thank you.